Hey guys, welcome back to the third or fourth video that I'm filming today. I've already talked to you guys about the updated option strategy that I'm planning to do. I also talked to you guys about the October income. So if you guys haven't seen that one, feel free to check those out today. And hopefully the next video that you guys are going to see, I'm going to be talking about the top 10 stocks within the portfolio. I started down this path about 6 months ago and then I completely dropped the ball. Had some other things kind of come into my life. And unfortunately for you guys, that just meant that it dropped the ball. So I'm going to reveal to you guys, and I'm probably going to clickbait you guys and say that I'm only going to do 5, but in actuality, I'm going to give you guys 10. So make sure you guys hit that subscribe button, and you also see the top 10 for dividend pairs as well. And hopefully we can get you guys to see about what my top 10 company stocks are by value in this video, and in the future video, top 10 companies by income coming through the portfolio. Now, this is strictly going to be stock market only, or just, I guess, not maybe stock market only, but so yeah, let's just hop right into it at this point. There's no reason to kind of beat around the bush here, but currently portfolio value is around $550,000 after the last couple percentages we've shaved off due to the uncertainty with the ongoing elections. So we have that. We have $17,000 forward income coming from the portfolio in terms of dividends, about 4.4% dividend yield coming off of that. Now, of course, that's not off of the $550,000 because a lot of you guys in the comment section always chirp up saying, oh my God, if you multiply 4.5% by 550,000, that's not 17,000. You're right. There's what I have in the dividend portfolio, which is about 388,000, and what I have in the 401k. I can't break out what the dividend coming from the 401k is. So hopefully in the next couple months when I roll that over, it'll be a little bit more clear. But the majority of my money is in an individual brokerage account. So instead of beating around the bush, let's just hop right into the top 10 itself. The first of the 10 that I'm going to be talking about today is Exxon Mobil. So I purchased Exxon Mobil with a cost basis of around $53 at the moment. I have about 346 shares of it. Let me just do some quick fixing here with the formatting. So 346 shares here. So I'm down pretty significantly in this position in terms of cost basis, about $17,000 in terms of invested money into this, but the market value is around $11,000. So yeah, can't necessarily complain too much with this one. So we're yielding around $1,200 a year in dividends. So I'm pretty excited about that one. At the current price, around 32 bucks. I think it's a current buy for those of you guys that have not had it in your portfolio. I think that in the future with Guyana coming online and some of the Permian assets that they have, I think they're going to have a very low cost basis to continue to do business. So be sure if you don't have it in your portfolio to do some due diligence and see if it's something else that you want to include. And second one, obviously almost as obvious, which is Royal Dutch Shell. Current cost basis on this one is $30, have about 553 shares of this bad boy, and they cut the dividend pretty significantly earlier this year by about 2/3. So I would be expecting around $2,000 in dividends around this time, but because they cut the dividend by 2/3, we're basically down to $730. So I can't complain with that. It's a $13,000 position at the moment. Still in energy, I still think it's a very long-term play as they continue to transition to renewables. I think it's a really good opportunity for you guys to purchase a company. Really quick one about this one. They had $9 billion in cash flow just from this quarter alone. If you do the trailing 12 months, they have about $35 to $40 billion in cash flow over the past 12 months. And that's even during this sort of price environment in oil and gas. So think about it in that perspective and understand that when you're buying a company like this, which is sub $100 billion, I believe, it's like $90 billion, you're basically getting cash flow from price to cash flow of around 2.5 times, which is absolutely absurd. So keep that in mind in the future. Now going on to number 9 in the portfolio. Whoops, screwed that one up here. Just give me a quick sec. We have Cardone Capital. It's a $15,000 investment I did in the private real estate investment trust. So this one gets a little heated as well in the comment section. So feel free to heat it up in there. That's perfectly fine with me. Getting about $600 a year in dividends from that. But I guess to give you guys some context, so last year I got about $8,300 in depreciation for my investment in Cardone Capital. So this year with some of the private businesses and stuff that I own, it'll be nice to be able to take that $8,300 in depreciation and basically get that off of my taxes for next year. for 2020. And whatever I get, sorry, that $8,300 was in 2019, and whatever depreciation I get this year in 2020 will be nice as well. So you think about it, if I'm in the 25% tax bracket, it's at least $2,000 that I can take in terms of tax relief that I don't have to pay based off of that aspect of things. So while the $600 might not be that great, the depreciation value is pretty significant, especially to small business owners. So that one's in real estate there. Can't complain with that one. I like it a lot. Wells Fargo, down huge on this position. I'm going to continue to buy. Wells Fargo is another one of those companies that is absolutely crushing it in terms of earnings. Yes, they were down 17, 18% year over year in terms of profit. But at the end of the day, does that warrant the price of the stock going down by about 50, 60%? I think the answer to that is no. So my current cost basis is around $34 for this one. I have about 702 shares. I really would like to get this up to 1,000 shares. But my cost basis, as you guys can see, is around $23,000. The price of the company at the moment, or the shares in my portfolio, is around $15,000. So a huge loss, almost $8,000 loss. But I think that when the company does turn around and it gets back to the $50, $60 range, this one will look pretty good. It'll be about a $40,000 position, in my opinion, within the next year or two. And yeah, I think that it's going to continue to raise the dividend as well. $280 a year in dividends. So this used to be closer to about 4 or 5 times that. So over $1,000 a year in dividends that I was getting, but they cut the dividend to be able to their balance sheet kind of back in line. Now, I think when you guys think about Wells Fargo, you're like, oh my God, it's a dud, yada, yada, yada. I think that's the mainstream media really hitting this one. The Fed really imposed improper sanctions, in my opinion, on Wells Fargo, not allowing them to expand their balance sheet, which is hugely a big reason why the bank companies do really well. If you can't expand your balance sheet, you can't expand your net assets, then of course your net income, especially with this depreciating interest rate environment, is going to continue to go down on a day-to-day basis. So I think as soon as the Fed lifts that sort of sanction, it's game over for all these other companies that are there. Not to say it's going to drive them out of business, but it's going to be Wells Fargo returning back to the drawing board and being able to get a really good amount of money back into their coffers. So right now, I think their net interest is really taking a big hit based off the fact that people are repaying some of these assets that have been bought, and they can't really issue more and more and more and be able to recover based off of volume because they can't expand the balance sheet. So they have to rely on basically people paying back their loans and then reissuing that money in lower interest rate environment. So somebody might be paying off a 3% mortgage right now, and then they have to reissue a mortgage at 2%. Obviously, they're going to take a net loss on that year over year, just based on the fact that they can't issue out more. So yes, in the old environment, it used to be that they could issue out maybe 2 mortgages out for the amount of money that somebody is paying back on that one mortgage. They'd be able to issue out 2 mortgages at 2%. So that would really be the equivalent of having 1 mortgage at say 4% money, and they'd actually be able to expand and get more income based off of that. But maybe it's not a perfect analogy, maybe it's not exactly how it works, but it gives you an idea as to how the Fed is improperly, I guess, hindering Wells Fargo as an organization, which I don't necessarily think they should. I don't think that they are in any worse shape than, say, any of these other financial companies. I think it's just the scandal that they had with the fake checking accounts, and they're still getting attacked for that. So then you have Caterpillar here, really good one as well. Really enjoy my position here in Caterpillar. This is an industrial stock. I have about 90 or 100 shares of this bad boy for about $16,000. Cost basis is down pretty significantly, $11,500. That means I'm up about $4,000 on this position, 37%. So pretty excited about that one. I was up way up, about $170 a share. So this thing was up close to 50%. And I was writing covered calls on it and making some good cash. Still writing covered calls on it, still making good cash on it. But yeah, can't complain at all. $414 a year in dividends. So it's able to buy me another fraction of a share every single quarter, which I can't complain with, and hopefully get this up to a 200, 300 share position here in the next couple of years. I like Caterpillar a lot. I think it's run up pretty significantly. I don't know with what happens with the elections, if it's going to go up or down, because it is infrastructure based. So anyway, really good company there, can't complain. And then number 5, sorry, I keep doing that. Number 5 here is AbbVie, and I think actually there's 2 positions in AbbVie here, so I'm going to do them together. So overall, it's about $17,500 or so in AbbVie, 206 shares overall. Pretty good cost basis on the two, $78 in my individual brokerage account, $65 in a separate account with a very small position. Overall, it's about $1,000 a year in dividend income coming into the portfolio. Really good position. I love this company. I think it's going to continue to do well. They merged with a different company that owned Botox. I don't remember the exact name of it, but I don't see Botox going away. I don't see AbbVie going away either. I think they have a good pipeline of drugs. And they've gotten into more cosmetic drugs as well with their purchase of the other company. And so I think that, not only are they getting, they have Humira and stuff like that, which is going to continue to be a good cash flow generator over the next 2 years or so, but they have these other companies as well. And so I think a lot of the reasons why this company is depressed in terms of price is the people's fear about Humira coming off of patent in the next 2 years. And Humira is a big chunk of their revenue that kind of comes in, but they have additional pipeline of drugs. And I think that with Humira coming offline, they'll be able to get their earnings back up. And I don't think everyone's going to get off of Humira day one, but at the moment, the company is being priced as if everyone's going to stop buying Humira as soon as it gets generic. So anyway, hopping over to number 4, there's actually 2 positions in number 4 as well. So that is Altria Group. I'm a huge fan of Altria Group. I don't use any of their products, but I know people that do. They love them, and I think that Altria Group is well diversified. They own 10% of AB InBev. They own a wine company. They own smokeless products. They own part ownership in Juul. They own part ownership in Kronos, which is an MJ company. So they have a lot of fingers in a lot of different pies. They're basically a sin stock conglomerate, which I think is a huge opportunity going forward. Currently down my position in Altria Group. Currently have a cost basis around $43 there for the larger position, 450 shares. So I have over 475 shares in both accounts. I think it's a great company. If you look at the price to earnings ratio, man, you're basically paying for pennies on the dollar. And I mean, this has got free cash flow at the wazoo, enough to pay the dividend. So I think a lot of people are concerned about the dividend, just looking on an EPS perspective or an earnings per share perspective. But in actuality, earnings per share can get basically manipulated by tax write-offs and things of the like. So what you need to look at is cash flow from operations. And if you look at cash flow from operations, this company barely spends any money on capital expenditures and puts a lot of that money into the dividend and shareholders. So margins are great, and I think that this is a great company to own. And I think when things kind of turn around for this company and a lot of the Juul write-offs kind of stop, because I think at this point they've written down the Juul purchase price down to about $5 billion. I think that earnings per share will continue to shine through, and they'll be like, well, why is this company being so badly hurt? But I think what ended up happening is they bought Juul, they wrote it down, and I think over the past 2 years, they've really been hit by that. And I think once all those write-downs are done, the company will kind of turn around and exit the channel, the downward sloping channel it's been in for the past 2 years. So over $17,000 in this company. I love it. It's paying me over $1,500 a year, almost $1,600 a year, so $400 a quarter just in this company alone. And hopefully this one will be up there in the 4-digit club here pretty soon. I accidentally revealed 2 of these positions here by accident, so I might as well just unveil both of them at the same time. So number 3 is Pepsico. I have 135 shares of Pepsico, $550 a year in dividends. That's not healthcare actually, so don't believe in that one. I think it's more of a consumer staple, I think. Yeah, I accidentally screwed that one up. I had to copy another sheet over because obviously my sheet doesn't, it does allow you to look in terms of market value, but then I had to erase a bunch of cells and it might have screwed some stuff up. So $18,000 position, up pretty good on this one as well. Purchase price is around $119. On average, for all the shares that I have purchased, I purchased 132 shares. So now I'm just getting into the dividend reinvestment mode here, and up 14%, and can't complain with this one. I'm going to try to get this one up to 200 shares before the end of the year, fingers crossed, but we do only have 2 months left. So definitely within the next couple quarters, it'll be up to 200 shares, sorry. And yeah, that'll be that one, and hopefully keep that one at 200 shares for quite some time. Altria Group, everybody knows this is a big one in the portfolio. 435 shares basically, at about 55 bucks, $100 a month in dividend income. So I can't complain with that one. $25,000 position here. It's the second largest in the portfolio. And I think I'm just going to hold this one here at about 425, 430 shares, reinvest those dividends, of course. But yeah, I think for the time being, I think this is an okay position here. I want to scale some other positions up to around 25,000, Pepsico being one of them. Maybe Caterpillar, maybe Altria Group as well. If Altria Groups continue to be so cheap down in this particular neck of the woods, I'll probably get that up to 25,000. But yeah, right now, I think Altria Group is probably the first company I had at 25,000. And so that's kind of the goal now, is to get some of these bad boys to 25,000. That's about 5% of the portfolio value. If you kind of look at it that way, is 25,000. So $500,000, $550,000, 5% of that is like $25,000, $26,000. So if I'm able to get a couple of these companies up to that 5-6% range, I'm comfortable with that. I'm not that much more comfortable going above 7-8%. And so for a while, it was around $15,000 as that 5% target, and I got a lot of those companies up to that. And you can see a lot of these companies are around that 15,000 range. But now that the portfolios continue to grow, add capital every single month, and also the companies just grow as well most of the time, it's gotten up to 25,000. So we're gonna have to get some of these other companies up to there. So the last company, which you guys probably will not be surprised about, is Johnson & Johnson. So I have Johnson & Johnson in 2 accounts. I have my individual brokerage account. I also have it in my M1 Finance account. I think overall it's about a $26,000 position, 25.5. So just a hair above the Altria Group position here. Doing relatively well with this position as well. It's kind of break even for a lot of these companies just because of the recent dip that we've had, the past 5-10% dip that we've had over the past couple weeks. So overall, paying me about $750 a year in dividends, really high quality dividends being raised every single year. 185 shares, basically 187 shares, which is nice. Going to continue to reinvest these throughout time here, and hopefully would like to get this up to 200 shares just in the individual brokerage account. So I have about 35 shares that I need to go in this particular account itself. That would get this up to that $25,000 mark on its own, really, just in the individual brokerage account. And then I think I'd be done with that. So I do have in my M1 Finance account 3% of it allocated to Johnson & Johnson, but at the moment it's way overvalued in terms of that. I think it's like 10 to 15% of the M1 Finance is in Johnson & Johnson. So as it continues to invest in those other things, eventually it'll get the M1 Finance Johnson & Johnson position down to 3%, and it'll start adding into that constantly. So I'm a big fan of Johnson & Johnson. They have a huge moat of a bunch of different products, Band-Aids, what have you, you name it. They probably own a piece of it. So like this company a lot, continued dividend increaser, and just has a huge moat of a bunch of different products and huge conglomerate of healthcare products. And I don't see this company going anywhere. They've been a huge staple within the S&P 500 for a very long time, and I think they'll continue to do so. So really hope this video helps you guys see what my top 10 stocks really are. And so we have everything ranging from healthcare, energy stocks, real estate, to consumer staples as well. And we also have industrials in there with Caterpillar. So really hope this one helps. Overall, these companies, these top 10 companies, pay for about $8,500 worth of my dividends, which is almost half, because I get about 17,000. So a lot of these companies are paying for about half of my dividend income here, and continue to see them expand in that respect, just based off the fact that I like a lot of these companies. I don't see a lot of them going anywhere, and I think a lot of them are going to continue to raise the dividend. Exxon, I don't see them cutting the dividend, to be honest. Shell announced committing to having more dividends as well. And Wells Fargo, I think that one's going to continue to raise the dividends going forward. And so without the cuts, this one would have definitely been over 50%. So Shell and Wells Fargo obviously cut the dividend. And so with that, we've lost probably over $2,000 worth of dividend income just from this particular part of the portfolio alone. And so expect this one to get above $10,000 relatively soon as some of those dividends are reinstated and grown, and as well as me adding more additional capital to the portfolio. So anyway, guys, really hope you guys enjoyed this video. Look out and subscribe to make sure you get the companies that pay me the 10 highest amount of dividends. Some of these will probably be in there. In fact, I guarantee a lot of these will be in there, but there are some companies that pay me a pretty good dividend that aren't in this list. So make sure you tune in for that and see what is my #1 dividend paying stock. So thanks, guys. See you on the next video. Cheers.